Welcome to Investor Web, the YouTube channel that simplifies the complex world of business and entrepreneurship for you. Here, we translate intricate economic jargon into a language you can easily comprehend. Our mission? To equip you with the knowledge and insights you need to navigate the world of business, whether you're a seasoned investor or just starting out on your entrepreneurial journey. From engaging discussions about various business strategies to enlightening tutorials on spotting lucrative investment opportunities, Investor Web is your go-to resource. We strive to make the often intimidating world of finance and entrepreneurship accessible and exciting for everyone. On this channel, we don't just scratch the surface, we delve deep. Today we dive into a fascinating topic: how to build a monopoly. This isn't just about ruling the market, it's about understanding the dynamics that allow a company to dominate. So get comfortable and stay tuned as we unravel the steps. Before embarking on the journey of building a monopoly, understanding what a monopoly is becomes crucial. Let's break it down. In its simplest form, a monopoly is a market structure characterized by a single seller selling a unique product in the market. In a monopoly market, the seller faces no competition as he is the sole seller of goods with no close substitute. But what does this mean in practical terms? Think about a game of Monopoly. You start buying properties, and before you know it, you own an entire side of the board. No one can build houses or hotels without your say-so. You effectively control the market on that side of the board. That's a monopoly in a nutshell. Now, not all monopolies are created equal. Some are born out of innovation, where a business creates a product so unique no one else can replicate it. Others result from a company becoming so large and powerful that it can undercut its competitors, eventually driving them out of business. A monopoly can also arise from government regulation. For instance, a government might grant a single firm the right to be the sole provider of a particular good or service in a specific market, creating what we call a legal monopoly. The implications of a monopoly can be both positive and negative. On the positive side, monopolies can lead to economies of scale, allowing companies to lower costs and potentially pass savings on to consumers. On the downside, monopolies can stifle competition, leading to higher prices, lower quality goods and services, and less choice for consumers. Now, it's essential to note that while monopolies can be highly profitable, they're not always legal. Many countries have laws in place to prevent the formation of monopolies or to regulate their behavior once they're established, to protect consumers and maintain a healthy competitive market. Now that we have a basic understanding of monopolies, let's delve into how one can be built. The first step in building a monopoly involves identifying a unique product or service. This is the cornerstone upon which your monopoly will be built. Imagine yourself as a gold prospector, but instead of a nugget of gold, you're seeking that one-of-a-kind product or service that sets you apart from the crowd. An exceptional example of this is Google. They revolutionized the way we search for information online, creating a product so unique it's now used as a verb. Another example is Microsoft, who developed an operating system that became the standard for personal computers worldwide. These monopolies began with a unique product, which is the first step to building a monopoly. Having a unique product or service isn't just about being different, it's about providing value in a way no one else can. It's about finding that gap in the market and filling it with something extraordinary. Once you have a unique product or service, the next step is to create barriers to entry. Creating barriers to entry is a strategic move that can establish your monopoly. But what exactly are these barriers? Simply put, they are obstacles that make it difficult for new competitors to enter a market. These hurdles are incredibly important tools in the creation of a monopoly, providing a fortress of sorts, protecting your unique product or service from potential invaders. Now let's delve into the various strategies to create these barriers. First off, we have patents. Patents grant you, the inventor, exclusive rights to your invention for a certain period of time. This means that no one else can produce, sell, or use your invention without your permission. It's like having a royal decree, protecting your monopoly kingdom from the onslaught of potential competitors. Next, we have the strategy of high initial investment. This is when the cost of entry into a market is so high that it deters potential entrants. Think of it as a towering wall surrounding your monopoly castle. It's not impossible to scale, but it's certainly not inviting. It can be anything from the cost of technology, infrastructure, or even the cost of acquiring skilled labor. Another strategy is the acquisition of exclusive rights. This can be in the form of exclusive contracts with suppliers, exclusive access to resources, or even exclusive distribution rights. It's like being the only merchant in the kingdom with access to a rare and precious resource. But remember, creating barriers to entry isn't just about keeping competitors out, it's also about creating a competitive advantage that allows your monopoly to thrive and grow. It's about creating a landscape where your business is the only game in town and everyone else is simply a spectator. Creating barriers to entry isn't a one-time task. It requires constant vigilance, innovation, and strategic thinking. It's about always being one step ahead of your potential competitors, always ready to fortify your castle at the first sign of a siege. With barriers in place, the next step is to achieve cost advantages. Achieving cost advantages can secure your monopoly by making it difficult for competitors to match your prices. Cost advantages are a cornerstone of monopoly building. The cornerstone, if you will, that keeps your monopoly fortress standing tall against the onslaught of competitors. But how exactly do you gain these cost advantages? Firstly, let's talk about economies of scale. This is when producing more of a good or service becomes cheaper the more you produce. Think of it as a bulk buy discount from your supplier. The more you buy, the cheaper each unit becomes. In the business world, this could translate to a lower cost per unit as output increases. The more products or services you provide, the lower your cost per item, giving you a pricing edge over your competitors. Another way to achieve cost advantages is through superior technology. By investing in advanced technology, you can increase your productivity, reduce costs, and improve quality. This could mean anything from automated machinery to advanced software systems. The initial investment may be substantial, but the long-term benefits can be immense, allowing you to offer your product or service at a lower price than your competitors. Then there's access to cheaper resources. This could come in many forms, from striking a deal with suppliers for lower prices to owning resources outright. The idea is to lower your production costs, enabling you to undercut your competitors on price while still maintaining a healthy profit margin. Lastly, consider the benefits of vertical integration. This is when a company controls more than one stage of the supply chain, such as manufacturing, distribution, and retail. This can lead to significant cost savings, as it eliminates the need for middlemen and allows for greater control over costs. With cost advantages, you are well on your way to building a monopoly, but there's one more step. So stay tuned, because the path to monopoly isn't just about cost advantages. It's about taking strategic steps to secure your position in the market. The final step in building a monopoly is maintaining it. We've built the fortress, now it's time to guard it. One of the most crucial tactics is continuous innovation. Keep pushing the boundaries, always stay a step ahead of the competition, and ensure you're consistently offering something new and exciting. Another strategy is implementing customer loyalty programs. These initiatives can create a bond between your business and your customers, encouraging them to stick around. Think of it as throwing a party. Once the guests are in, you want to keep them entertained so they won't leave. Lastly, let's not forget about leveraging network effects. As your customer base grows, the value of your product or service increases for new customers. It's the snowball effect. The bigger the snowball gets, the more snow it picks up. So that's how you build and maintain a monopoly. It's a game of strategy, innovation, and adaptability. Are you ready to play? Building a monopoly is a complex process, but it can be achieved with strategic planning and execution. We've explored the intricacies of understanding monopolies, recognizing the power they hold within the market. This journey began with identifying a unique product or service, something that sets you apart from your competition, giving you the edge. We then moved on to creating barriers to entry. These barriers, whether they're patents, licenses, or simply high startup costs, can protect your unique offering from copycats. Achieving cost advantages was our next step. By increasing efficiency, buying in bulk, or leveraging economies of scale, you can lower costs and undercut your competition. Finally, we discussed maintaining the monopoly. This is where your strategic planning really comes into play, ensuring that you stay ahead of the curve, continually innovating and adapting to market changes. Remember, with great power comes great responsibility. Use your monopoly for the good of the market and consumers. Thanks for watching Investor Web. Don't forget to subscribe for more insightful videos.